The Federal Reserve thinks the economy is fine. The markets think recession is coming. One of them is wrong. And here's the scary part. The margin for error is razor thin. A Moody's economist just said, "Nothing else can go wrong." Not exactly a ringing endorsement. In this video, I'm breaking down what's actually happening to the global economy heading into 2026 and what it means for your money. Let's dive in. We're starting with the most alarming signal nobody's talking about. Manufacturing is collapsing. For 9 consecutive months, the manufacturing sector has been in contraction. The Purchasing Managers' Index, which is a key economic indicator that measures the health of the manufacturing sector, falling below 50, and that means the sector is shrinking. In December 2025, that number was 51.8. The month before, 52.2. And here's what's critical. Manufacturers aren't making temporary adjustments because of tariffs. They're moving production offshore permanently. They're cutting staff for the long term. One analyst said it perfectly. The manufacturing sector is unwell. This matters because manufacturing employs millions and signals where the broader economy is headed. But manufacturing is just part of the story. The services sector, which employs 80% of America, is now losing momentum too. In December, the services PMI dropped to 52.9, down from 54.1 the month before. That's the lowest in 6 months. And here's what worries economists. New business inflows hit a 20-month low. That means companies aren't getting new orders, which means hiring will slow, which means wage growth will stall. This is a chain reaction. The engine of the American economy is sputtering. Now let's talk about unemployment, because this is where things get dangerous. Back in August, unemployment was 4.3%. In November 2025, it jumped to 4.6%. That's the highest since September 2021. The trend is unmistakably upward. And here's the problem. Historically, when unemployment crosses 5% and keeps rising, recession typically follows within 6 to 12 months. We're not there yet, but we're getting close. Job openings are declining. The quits rate is low, meaning people don't have confidence to jump to new jobs, and wage growth is slowing. The Federal Reserve is projecting only one rate cut for all of 2026. But if unemployment hits 5%, the Fed will be forced to cut rates aggressively. And that contradiction? That's a recession setup. Now let's talk about consumer spending, which accounts for 70% of the American economy. Think about that for a second. In 2024, consumer spending grew 5.7%. In 2025, it slowed to 3.7%. For 2026, forecasts show only 2.9% growth. That's a collapse, and the reasons are brutal. Tariffs raising prices on everything, wage growth cooling because the labor market is weakening, credit card delinquencies rising, and a quarter of American households living paycheck to paycheck. Here's the income divide. The top third of households are still spending and keeping the economy afloat. The bottom 2/3 are cutting back and trading down to discount retailers. That means premium brands are losing customers and dollar stores are packed. That's not a healthy consumer, that's a consumer in stress. Here's where the Fed's decision gets really messy. The Fed is projecting only one rate cut for 2026, ending rates at 3.25 to 3.5%. But the futures markets are pricing in 3 to 4 cuts, with rates falling to 3% or below. That's a 50 to 75 basis point gap between what the Fed expects and what the market expects. One of them is going to be wrong. If the Fed cuts too slowly, while unemployment is rising and manufacturing is collapsing, the recession deepens. If the Fed cuts too fast, while inflation is still above target, prices start rising again and the credibility damage is real. And complicating everything, Fed Chair Powell's term expires in May 2026. Political pressure for rate cuts will intensify. This is an impossible position. So here's the bottom line on recession risk. Moody's Analytics puts it at 42%. Bloomberg's consensus is 30%. That's not certain, but it's elevated. Mark Zandi, Moody's chief economist, said, "I think we'll most likely get through 2026 without a downturn, but nothing else can go wrong." That's not confidence, that's a warning. Globally, the picture is different. Europe is stuck at 1.1 to 1.2% growth, basically stagnation. The UK is at 0.9%, but India? Still 6.5% growth, making it the world's fastest growing major economy. India is resilient because while tariffs hit some sectors, pharma and semiconductors are exempt, and the government is supporting growth. This matters because it shows the US and Europe are weakening while emerging markets hold up better. Now, a 30 to 42% recession probability doesn't happen randomly. There are 10 specific risks that could trigger it. First, the AI investment bubble could burst. AI contributed 1 whole percentage point to US growth in 2025. If venture funding dries up, data center construction collapses, and the economy slows. Second, tariff escalation. Trump could raise tariffs to 25 to 50% across the board, which would inflate prices and slow global trade. Third, labor market deterioration. If unemployment breaks above 5%, the Fed is forced to cut rates aggressively, potentially missing the inflation target. Fourth, inflation resurgence. AI data centers could strain electricity grids, supply chain constraints could emerge, wages could accelerate, and suddenly central banks have to hike instead of cut. Beyond these top 4, there are geopolitical risks, oil price shocks, consumer credit crises, and housing market deterioration. Any one of these could be the trigger. So how do you position your money in a world of slow growth and elevated recession risk? First scenario, no recession happens, which is 60% likely. In that case, focus on defensive sectors, healthcare, which has inelastic demand, defense contractors, because NATO is spending, dividend stocks, discount retailers, because consumers are trading down, and utilities for stability. Avoid unprofitable tech, premium consumer goods, and housing stocks. Second scenario, mild recession hits, which is 30 to 40% likely. Flight to safety becomes the strategy. Buy US Treasury bonds, investment-grade corporate bonds, gold, dividend aristocrats, consumer staples, and utilities. Avoid cyclicals, growth tech, emerging markets, and junk bonds. And regardless of scenario, cash at 4.5 to 5% yields is actually attractive right now. Lock in these rates before they compress when the Fed cuts. Here's the truth. 2026 won't be another 2008 crash or 2020 shutdown. But growth will be anemic, sectors will suffer, and the economy will test whether you're prepared. The margin for error is razor thin, and nothing else can go wrong. But with the right strategy, you can position yourself to win in slow growth scenarios. That's what separates smart investors from reactive ones. If this analysis was valuable, smash that subscribe button right now.